All right, good afternoon, everybody. Welcome to another edition of the Polaris Trading Group PTG educational series. And today we will be discussing the PTG CCI crossover method, i.e. the premium and discount. Module 19 now, and today is November 23rd, 2016. Before we begin, industry regulations require that I at least notify you of the NFA Compliance Rule 2-29. Simply states that trading futures and options on futures and derivatives, such as the ESE Mini and indexes, involve substantial risk of loss, and past performance is not indicative of future results. So let's get right into the topic today. And the topic is the Commodities Channel Index, background and calculation. The Commodity Channel Index is our core indicator that we use for our premium and discount crossover trade system. And it was originally developed back in 1980 by Donald Lambert. And he was featured, the article on the CCI was featured back in Commodities Magazine. It's a real interesting indicator. I refer to it as my all-terrain vehicle, and the reason for that is we're able to identify trending conditions as well as range type conditions, and where it will very accurately identify what are called extreme conditions. Some people also refer to that as overbought and oversold. We refer to those as extreme conditions. And it's at the extremes where there's trade opportunity. So it measures price relative to an average price, right, over a given period of time. That's not much different than a lot of other indicators, but how it actually is calculated is the unique part of it. So the CCI is relatively high, and again, relative, all right, is the key operative word here. Relatively high when prices are far above the average. Now the question becomes, how far above the average? Okay, I get it that when it's relatively high, but what is relative, and how does that equate to how far above or below the average? Okay, and again, the indicator will be showing you that, and in practical use, you'll get to see how it works. But in the CCI is relatively low, of course, when prices are far below. And again, begs the same question, well, how far below? What does that mean? All right. So some of the little technical stuff here you can read on your own. All right. When you review the video, I'm not going to get into the actual formula. Again, trying to keep the math to a relative minimum. The key, though, that we want to take away from kind of the mathematics here of the formula is that what Donald Lambert did is he created a constant figure that basically ensured that 70 to 80% of the CCI values would fall in between 100 and minus 100. So if 70 to 80% of the values are between plus and minus 100, then we want to stay away from that middle zone where the CCI is located. All right, so we want to get so how we define our premium and discounts is the area above 100 or below 100. That becomes the key zones that we want to then look to transact business in. Okay, so that's the key part of the takeaway of how the formula works. All right, and it calculates a mean deviation here versus a standard deviation. Many of you may be familiar with Bollinger Bands, and in many respects there's similarities to how this indicator works, but it actually, a mean deviation is absolutely different than a standard deviation, and there in the fact that it's a mean versus a standard. And again, that gets into a whole other realm of what's the difference. But the bottom line is it's a real good indicator. It offers both trending conditions as well as range conditions, and again, very useful for us. Okay, so basically that's some of the technical background, but how do we interpret it? And that's really where the rubber meets the road, and where I want you guys to understand is really the interpretation, and then how we're able to then use this. All right, so the CCI measures the difference between a security's price change and its average price, by definition. So basically, high positive readings indicate the prices are, of course, well above their average, which shows strength. And then low negative readings indicates weakness, as prices are well below their average. So again, by definition, and you've heard me say this in our trading room over and over again, that premium by definition indicates price strength, and discount by definition indicates price weakness. So that's important to understand. But we're going to take that core definition and be able to mold it into trading decisions, okay, on a day-to-day basis through our premium discount. So the CCI basically can be used as a coincidence or a leading indicator, and we'll show you some examples of that. All right, as a coincidence indicator, the surges or strength above the 100 reflect strong price action. All right, and that can indicate that that there's a beginning of a price trend. It also can indicate a ending of a price trend, right, at an exhaustion point. And then when the indicator plunges now below that minus 100 level, okay, that could indicate the beginning of a new downtrend. So what that really means is there new price momentum? Is there a new momentum high, or is there a new momentum low? And momentum highs and momentum lows are different than price highs and price lows. All right, so we'll eventually look at some of those examples. As a leading indicator, though, all right, prices can look for, again, traders can look for overbought and oversold conditions, all right, that potentially can foreshadow a mean reversion. So again, price divergences, bearish and bullish divergences come to mind. All right, a lot of times when there's momentum divergence with price, that can again foreshadow a beginning of a reversal. Now, keep one thing in mind regarding reversals and divergences. Not every reversal in price has a divergent component to it, but most and the best reversals have a divergence component. So not all divergences lead to a reversal. And that's something that can confuse a lot of people. They just say, oh yeah, there's price divergent. Okay, I'm going to, counter trend that. Be careful when you do that, because when there's divergences, you want to make sure you're at a key level, and there's this confirmation of divergences. Okay, and we're gonna show you that as well. All right, in a couple graphics here. So using it as a coincidence indicator, meaning that a new trend is emerging. All right, we want to make sure that, again, the majority of just as a review, the majority of the CCI movements occur between plus and minus 100. So that's the middle zone that we want to stay away from. But as the indicator moves and exceeds that range, above plus 100 or below minus 100, right, there is something developing. There's a price change developing. And we want to be able to read the action as it's unfolding and say, is this a new developing up move or down move? Okay? And you can basically think of the CCI as a bullish and bearish, filter. All right, and so you can see in this graphic here, all right, where the end of the prior directional move up had a divergence to it. So as prices kept moving higher, all right, the momentum that was driving the price higher, right, was declining progressively. Now, again, it's difficult. Notice here, as it was diverging, and there was early divergence, price kept going higher. So, it's very difficult to just say, okay, here's divergence, I'm going to short them. So we need to have some sort of a trigger, etc., in order to get in to a divergence signal. Usually a pivot, and then a violation of a price low or a price high. Now, in our CCI indicator, we have what's called a dual CCI, and this is going to be important. So if you take a look at the CCI graphic down here, all right, the CCI indicator is composed of 3 lines, or three calculations. One, the 89, which is represented by the blue and red histogram, and then 2, the 34, what we call the fast line, and that is the white line. Okay, and again, all these oscillate. And then the last calculation is a turbo CCI, which is a 16 setting on our inputs, about half the value of the 34, and that's the yellow. All right, and they can be fairly erratic in what they show, how it displays on the chart, but don't worry about the erraticness of it. It's actually designed that way, and it can give us some very, very crisp signals. Now, in terms of a new trend developing, all right, some of the components that you want to be paying attention to as their potential. Now, always the best new trends emerge following price has reached a particular price zone or target, whether it's to the downside in this graphic or to the upside. Once it's reached the level, the buyers in an example like this would have gotten exhausted. Sellers begin to emerge, right? And in this particular case, you can see where this star is located on our screen here, and that indicates down here on the oscillator that price broke through the 100 line to the minus 100 line, and actually broke through the minus 200 line. This indicates what we call a 200 extreme on our indicator. This tells us that there's new price momentum to the downside. Now, if it was still bullish, all right, a pullback in price generally would show only a pullback to about the minus 100 line or slightly below, and then a hook back up, and then you would get a pivot in our price, and that would be what we'd be looking for in terms of a discount. All right, but when we get a 200 extreme like this, all right, it generally will begin to say, hey, there's something changing here that is not normal, or what is expected to be normal, and this could indicate a new emerging potential for a directional move. So as you can see here in the price, on our price bars, we had a number of discount signals. So the blue arrows indicate turbos, and the white arrow here indicates the standard discount, the 34 setting. But if you notice here, the price never pivoted. All right, it never stopped, pivoted, and made it, new high bars. So there were progressively lower highs and lower lows through this area. All right, after the market made a new momentum low. So this CCI actually gave us an early signal of new emerging weakness in this case, all right, at this point. So again, moves beyond the plus and minus 100 need to be noted, and then moves above or below the 200 levels as well need to be noted, especially on 200 extremes, because most new emerging directional moves generally happen when prices have moved to the 200 extreme levels. Not all of them, but a good portion of them. So at this point, again, remember, by definition, discounts represent weakness. So this is actually discounts or weakness in new weakening conditions. Now that's going to be important to understand. These are discounts, which by definition is weakness, in new weakening conditions. So that's a discount in weakness. That is a condition where we do not want to be looking to buy. And I'll establish some rules for everybody in a slide down the road here. All right, so a discount that does not pivot in weakening conditions, we want to avoid on the buy side. So as you can see here, the market rolled over continuously. The CCI here crossed the 89, which is the blue and the red histogram, all right, crossed the zero line. That indicates a trend change. All right, so the blue and the red histograms offer us a glimpse of how the trend or the quality of the trend is developing. And as you can see here on this, from the peak of plus 200 over here, where we had some negative divergence, the trend conditions kept weakening and weakening and weakening and weakening to the point where you get the cross of the histograms. And that then sets in motion that this is a new downtrend. Now, we had early signals of a potential new trend emerging. Once the histograms cross, that's a confirmation of it. All right, so now at this point, with the new red histograms as it's developing, the mode that we're in is we're looking to sell premiums, or we're looking to sell bounces or retracements within the context of the new developing down condition. So as you can see here, is going a little bit further, we had another signal of a 200 extreme to the downside. All right, so that is actually telling us there is an extreme amount of weakness now in price. So when we get this first retracement back on a premium, and this is a very good valid premium here, that's the level that we want to take. And I drew this, in this particular chart, I drew this horizontal line to show that the prior support pivots here, all right, at this price level was now broken, and a retracement back is not, even though a price bounces up a little bit, that's not a buy. All right, that's an opportunity to, when that premium develops here in the price bars in the oscillator, we want to look to sell that. And that magenta dot here shows the short potential entry price, all right, for shorting that. So a new emerging trend with momentum, looking for a bounce and a premium condition. So this is a premium, and again, now let's go with a premium. Premium by definition indicates strength, but and that strength is represented by the bounce here in price. All right, but now premium here is unfolding in weakening conditions. So we want to sell strength, i.e. premium, in weakening conditions. Okay? That's going to be important. All right, so let's move on to the next slide. Now, in this particular slide, we're going to discuss how to use the CCI in range conditions. So again, when we define the zones where we want to take trades in using the CCI, the zone is we want to be above the plus 100 or below the minus 100 areas in the zones. Okay, so we want to watch closely where the CCI develops its pivot peaks, okay, and where price is relative to the up part of the range or the low part of the price range. And so we want to be looking to buy these dips in the discount zone, okay, when the price pushes down and the oscillator then pushes below the minus 100. All right, we want to be looking to buy into that zone. Now, keep in mind, this is in a range condition now, not a trending condition. In a trending conditions, we're only looking to sell or buy, in direction of the developing trend. In a range condition, we can do both. We can buy near the low end of the range. We can sell near the upper end of the range. And the CCI will offer us a very good indication of when that opportunity presents itself. Okay? Remember, in between the plus 100 or minus 100 zone, we want to stay away. We only want to be looking to buy and sell at the upper and lower regions of the oscillator, all right, as it's nearing the highs or lows and as it's turning and peaking. Okay? So the more extreme levels are needed for various situations. The plus or minus 200 levels we've discussed, all right, offer a very, very good point of entry. Now, the hard part for a lot of traders is they see strength in price because it's moving up quickly, but they have not been accurately defined what type of trade action is unfolding. It's very easy to get scared to say, I don't want to short this up here, nor do I want to buy this down here, because as price is moving to those upper and lower regions, prices can move very, very quickly, and the pace of trade can accelerate. But if you've accurately identified the type condition that price is in, i.e. either range or trend, it will determine how you're going to select your trades using the CCI. So in a range, okay, we want to try to get as close as we can above that plus 100 where the oscillator is peaking relative to where the price is at the upper portion of the range or lower portion of the range. Okay, so I think this shows a pretty good graphic of it where the price entered a range here on the left hand side, pushed up, all right, established a peak, not quite 200, just a little bit above the 100, kind of stalled out. So that not necessarily would be one where we would sell immediately, but as the market began developing range characteristics, all right, where it oscillated up, it oscillated down, oscillated up, oscillated down. So the early time that we can identify an oscillation like this, rather than trending conditions in the prior graphic, we can say, okay, I'm going to buy that dip. All right, I'm going to sell that bounce near the peaks. And when we trade a range with the CCI, you do not need to use the right side pivot rule. The right side pivot rule works best when there's trending conditions. When you're in a range type conditions, what you really want to be doing is nibbling, buying small amount, near that price point or near that price edge when the oscillator is in its condition where it's beyond that minus 100 or plus 100 or even near to the plus or minus 200 level. That's the statistical peak. Okay, these are statistical readings, and that's going to be where you're going to have the best opportunity to enter a trade near a price edge, okay, without having confirmation of a right side pivot rule. Because if the range is relatively narrow, using a right side pivot rule to initiate the position may not be the best option, because there may not be enough room to really make a decent profit. You can use the right side pivot rule if you're blending into the trade, meaning, so take for instance this area right here where price comes down and you've seen it test this level 3 times or so, and you say, okay, if it gets down here, I want to buy one on the downtick, right, at the at some peak below minus 100, enter one contract for instance, and then as it's moving back up, look at a prior bar high here using the 2 bar high method and say, I'll add a position right there on a second contract. So what you end up getting is you're getting an average of those two prices somewhere in between there, and that actually allows you to add a second contract or a third without adding any significant risk, and you're really buying them basically off the bottom. Okay? Now it's not without its inherent risk, where if you buy this, how do we know, will it hold or will it won't hold? We don't. And that's, as traders, we have to be willing to accept the fact that if I take a position, it may not work for me. All right, but by only buying a portion of your position, see if it's developing characteristics of working, then you can add to your position at a slightly higher price, the second contract as we described, without adding any real additional risk, and actually increases your odds of getting a more favorable trade out of it. Okay, so this is a range condition. All right, and again, this is why I call it my all-terrain vehicle. Now, in terms of the 89 histogram, you'll see that it's not really all that smooth in here. All right, you see, a number of oscillations along with the faster ones, and you're seeing it below the zero line, then it's up above the zero line, then it's below the zero line. So this particular graphic actually went on for a little bit further, showing range characteristics. And so when we are in range, and that's going to be the key point, how do we identify range? I will do my best for everybody in our membership, in our trading room, to identify that we're in more of a range type environment, and then it'll be up to you individually as you're looking at the oscillators to pick out where you want to enter. Okay, it's all about the formation rather than a particular price point. So just keep that in mind. You're looking for the peaks and the troughs in the oscillator, just as we do in a trending condition, but we're only using one direction. In a range where we have the ability to do both, buy and sell, back and forth, and capture these, some of the range swings. Okay, all right. So let's move on. Talk about some bullish bearish divergences. So again, the bullish divergence occurs when the underlying security makes a lower low over here, and the CCI makes a higher low, which basically indicates less downside momentum. Very classic. Everybody has seen divergences. The CCI is excellent on identifying divergences as well. I actually had to search back a little bit to find a bullish and a bearish divergence together on the same chart, because they don't typically occur as cleanly as this. They're typically outliers, but they do occur, and when they do occur, you're looking they can be very useful to take a trade. Now, a bearish divergence forms when the security price, whether it's an index, a stock, doesn't matter, makes a new high, and the CCI makes a lower low. Again, very classic. Now, the key here, as I mentioned earlier, not every divergence indicates a reversal. Divergence, first of all, indicates a loss of momentum, but that momentum may continue after a shallow pullback and then reemerge in the primary trend. So you really must be careful when you trade divergences. You need to make sure that the divergences are occurring at a key level. And we always go back to stating that price trade opportunities need to be at some sort of a measured or identified key level. All right, so keep that in mind as well. But what's going to be key here for any type of divergence is confirmation. Now, the confirmation can come in a couple different ways. I've offered a couple different choices here. One, in case of a bearish divergence, it can be confirmed with a break below the zero line. All right, break below zero in the CCI. So on this divergence here, all right, in taking a look at the oscillator, as this white line is breaking through that zero line right there, that is your confirmation. So if you were to put a vertical line there, which I did not do, but if you put a vertical line there, it's going to be represented by one of these bars. That's going to be the price entry point, all right, and then your stop will go above the divergent bar high, all right. Or you can use a support break on the price chart. So there's going to be, they may or may not coincide exactly where the zero line cross, or a price entry, or a support point. Maybe somebody would use this lower pivot down here as an entry point. That might be a little bit too far away. But again, it depends upon the situation. So either you can use the zero line cross of the oscillator, right? Or in a case like this, I would identify primarily where the 2-bar low is, or the 2-bar low. And generally speaking, using a 2-bar low high methodology entry technique is going to be very, very close to where that zero line cross. All right. By the time you take a look at where that zero line cross, if you're focusing your attention on the oscillator line, you're not paying attention to price. So I usually use the price method, all right, primarily. So for a bullish divergence, just the opposite then will apply. All right, as the divergent takes place where you have a higher momentum low, price breaks up through a 2-bar high level here, and then you can enter at that point. Your entry style, your choice. You can use a buy or a sell stop at a particular price point. You can just click the mouse and go market order. Again, it's going to be your choice, for entry. Again, using a 2-bar high or a 2-bar low type entry method, right side pivot rule. In a case of this, again, it's going to be very close to where that CCI will cross the zero line for oscillator confirmation. Okay. So again, keep in mind here, we're not talking now premium or discounts in the traditional premium and discount trending conditions, but we are talking about premium and discounts on the oscillator. So in a situation like this, we're not going to have a signal on the bar with a white alert bar and say discount divergence or premium divergence. At least not yet. That may be coming in the future, but at this point you'll need to look for divergences, and many people just simply trade divergences. That's the core part of their trade plan. I'm an oscillator divergence guy. That's what I want to do. That's what that person will do. That's what their trade is. But as a well-rounded trader, it's best to have competencies in a variety of different areas, simply because the market is very diverse, obviously, and if you're waiting around for one particular trade setup, you may miss out on an opportunity on some very good ones. So it's always good to have 2 or 3 different type of conditions where you're willing to take a trade from, whether it's a divergence condition here, or if it's an overbought and oversold in a range, and or if it's a trend. So you have some ability to kind of move around and have some flexibility to choose what you're looking for. Now again, keep in mind, most of these divergences, all right, will of course occur above or below that minus or plus 100 line, and many times you'll actually get a most of the best divergences, by the way, do not actually have a 200 extreme to them. They actually will stay below the 200 and kind of fade down or fade up. All right, and again, it's the whole idea is that there's a loss of momentum. As price is still pushing up or down, the momentum has given way. Very good oscillator, guys, using the CCI. I think it's one of the best out there. There are other oscillators that many people use, but I don't think the sensitivity of those oscillators can match what the CCI crossover methodology has. Now, many of you heard me over and over and over again in our trading room that trading in the middle of the market is dangerous. Is dangerous. Is it safe in the middle? Right? Me think not. And this graphic colorfully displays that. This gentleman sitting in his hammock, laying in his hammock, thinks he's safe between these 2 palm trees, not knowing what's lurking behind him or underneath him, that there's a bunch of sharks. So between the plus 100 and the minus 100 zone in the CCI, when that is oscillating back and forth in that area, that is a condition where you want to avoid. All right, we want to buy or sell when there's price momentum. When there's no price momentum, the oscillator will hang out in between, as it has many times. And when that's the case, we want to avoid that at all costs. It's not safe in the middle. And along the same lines in the thought process, not just with the CCI, but when price is trading around the point of control, the volume trend, the midpoint of the session, and it's oscillating back and forth, there's relatively no momentum in price, and that's what we refer to as the balance zone. And when you're in the balance zone, especially when you're right there in the middle, all right, both buyers and sellers are fairly equally matched, and again, there's no directional price momentum. That is an area, if you choose to trade, you choose to be trading with the sharks, because you can get eaten up very, very easily. So again, it's a colorful slide here, but it's a very important concept that you understand. Okay, so how to define the CCI premium and discount using our CCI crossover method. So now we're going to get into the actual premium and discounts. It's a bit of a formula, but again, don't fret. A little bit of technical stuff, but let's just walk through it together. So the components that we're going to use, and we do use, is basically 3 core moving averages, and then we use a larger one for longer term confirmation. But the 3 core ones we use, all exponential moving averages, 13, 34, 89. And so what are exactly moving averages? People use the term, but a lot of people don't understand what a moving average actually is. A moving average is simply a consensus, a price consensus of value over a specific time period. So 13 bars back, 34 bars back, 89 bars back, 178 bars back, whatever it is that you're measuring, it's a consensus of value at that point in time over X number of bars. But it's the relationship between each of the moving averages that actually offers a view of what the overall market is doing. So the perception of value basically, all right, is kind of in the eye of the beholder. So one trader's GTFO point is perhaps, as an intraday trader, could be a great opportunity from a longer term trader. So if you're a scalper and you've had a successful trade, and you're exiting your position at a particular price level, right, that you don't see it as attractive anymore because of your criteria that you use as a scalper, well, that may actually be a great opportunity for the next higher level intermediate term or longer term investor trader, right, to see that as a bargain. Right, so everybody has a different view based upon the time period that they're trading. So this is where, when we see a 13, 34, 89 combination, which by the way we use as our stacker condition and our trender, you can see how the change in the sentiment or the consensus is it either building stronger consensus, or if it's weakening and it's transitioning from a stronger condition to a weakening condition. You can see that progressive unfolding through comparing the moving average time frames. So this is the idea of what the perception of value is. Okay, so since price value is perceived, all right, again, everybody has a different notion of what value actually is. But we're going to define it simply by the 13, 34, 89, but primarily the 34, 89. And that was the core definition of our premiums and discounts. when we get into the turbo CCI, okay, that uses a little bit faster value, and but for the time being, what I want you to core understanding is the standard premium and discount definition. So I'll walk through it here. So discount is when price is less than or equal to the 89 exponential EMA, and the 34 EMA is still above or greater than the 89. If the 89 is above a rising 178, it's even a stronger condition. And the contraction and or is in red because not both conditions necessarily will occur at the same time. On the CCI indicator, though, which is primarily what we're focused on here today in our CCI crossover, is when the slow CCI line, which is representative by the 89, that's the blue histogram now, all right, and red histogram. But in terms of the discount, it's the blue histogram is greater than the 0 line, and then the fast CCI line, which is the white line, which is representative of the 34, is below the 0 line. Right? Or the fast CCI is less than the minus 100 line. Okay? So again, think about that plus 100, minus 100 level. Right? When the fast CCI gets underneath the 0 line or underneath the minus 100 line, that becomes a discounted condition. Then what we're looking for is a pivot back up. Try to visualize that first in your mind, because the better you can visualize it, and then when you start seeing it on the chart and in the oscillator, you'll understand it even that much more. So that's a discount. In terms of the premium, again, just the opposite. So again, try to visualize this, that where price is above, all right, an 89 EMA, and the 34 EMA is below. So picture an 89 EMA, picture a 34 EMA that's crossed below it, and then picture a price bar that's above the 89. That is a moving average condition for a premium. Going with the oscillator, the CCI indicator crossover, all right, you're going to have the slow CCI again, which is represented by the 89, so you can have a red histogram. So the red histogram is below the 0 line. Okay, and the fast CCI line is above the, which is the 34, which is above the 0 line. Okay, so actually let's go back for a moment to, let's see, a few slides back. So let me just, let's back up here a moment. Let's go back to this one. Okay, so this is an example of the premium. So on the CCI, all right, we have red histogram. That's the 89. So the slow CCI is below the 0 line. And then the fast CCI line, in this case, we're going to use the turbo, is above the plus 100 line. Okay, price moves up. Turbo is above the 100 line. Crosses back down. Gives us a signal. That's the premium alert. So the slow CCI is below, the fast CCI is at or above the 0, above the plus 100, hooks back down. Boom, that's the premium. The opposite is true if it's a discount. Okay? All right, let's go back to the next slide. Okay, so this is how we mathematically define the premium and discount. Let's move ahead, and we're going to show you the discount itself. All right, so this may make a little bit more sense using the graphic. Okay, so the discount, again, price is less than or equal to the 89, and the 34 is greater than the 89. So you can see the comparative of the moving averages here. All right, and if the 89 is above a 178, which is not shown in this particular graphic, all right, it's just stronger. Or with the CCI, the slow CCI line is greater than the 0. So looking at the graphic down here, right, the blue histogram is all above the 0 line, so that tells us we're in a trending condition upwards. The fast CCI line comes down underneath the minus 100 line here, all right, in these two occasions, and then hooks back up. That gives us a discount signal, gives us an alert bar, also gives us, on our software, gives us a magenta signal, and that tells us that it's a valid pivot, and you want to be buying that. That's your buy. All right, at or near that magenta dot, your stop goes below the low of the pivot, and you begin managing the trade. All right, we want to get the shift. We want to try to get that first pullback or subsequent pullback in a new emerging trend. Notice here we have a 200 extreme. What does this imply? We have a new momentum high in the oscillator. It suggests, that's the coincidence indicator. It's suggesting that we have new upside momentum developing in price. Okay, so we want to look to buy whatever the shallow pullback is into the discount territory. Statistically, that's going to be our best location to buy in terms of a discount. And as it's pivoting back upwards, we want to use, in this particular case, in a new emerging trend, right side pivot rule, boom, enters the trade. Okay? Very straightforward. The software generates the signals automatically. If you're using the Auto Trade Assistant and you have that turned on, it will automatically execute these trades for you if you have difficulty pulling the trigger on your own. But you can certainly do it manually or use the computer automation. Okay, so this is a discount using the CCI crossover. All right, let's go one more example. Let's talk about a premium now. What does a good premium look like? So, as we discussed, right, the premium price is at or above the 89. Okay, or in the CCI the 34 is below it, and or the CCI slow CCI line, which is the 89, right, is underneath the zeros line. So let's take a look at that. Since we're talking about the CCI crossover, over here down the bottom, you see where the 89 histogram went from blue to red. Again, now we have beginning of trending conditions to the sell side. All right, price rolls over. Now keep in mind, we spoke about earlier, here are a couple discounts. I know we're talking about premiums at the moment, but look at these discounts up at the top left. See how the 34 EMA, that's this green line here, angling down, that turns red right about there. And then here's the 89 EMA, which is about flat. So this is what we would call a converging trend lines, all right, or a negative or a descending triangle pattern. Now, from your technical analysis studies, a descending triangle pattern is a negative pattern, a descending triangle. So when you use even the moving averages, you can read it the same way. This is actually a descending triangle pattern. These discounts, by definition, is what? By definitions, discount is weakness. So, all right, prices here are in a weakening condition. Why? The price bars are below a descending 34. That's going to be important. Make a note of that to yourself. Price bars are below a descending angling 34. The 89 EMA here right now is flat. There's no angle or slope to it. That is not going to hold price. But a sloping moving average acts as a dynamic resistance or support barrier. Okay? So in this particular case here, we have new developing weakness. Oh, by the way, take a look at that star over here to the top left. Look where the oscillator was, right? So a new emerging trend condition beginning to develop. Okay? We don't want to be buying that discount up here for the fact that we're getting discount in weakness. All right? Okay, the hawk beak pattern, yeah, okay, I see that right in here. We can put a couple eyes in there right there, use those magenta dots there as an eye. There's your beak pattern, all right? Sure. No, that works good, all right? If that's what helps you identify it by naming it something that you can see, all the better, okay? So let's move on, all right? Weakness comes in, another 200 extreme, all right? We're looking for then a bounce. Look at where the 34 here crosses the 89 to the downside. It shades it from green to red now. We get the red zone. Here's your 178 moving average here. All right, it is now red. So now you have 34 below 89. Stronger when the 178 is descending in terms of a down move. Okay, so we have all our conditions here in terms of the moving averages in the proper condition for continued weakness. All right. Now all we're looking for is the oscillator here to give us a signal where, you know, price gives us a little bit of a retracement bounce, gives us a signal to get in. There you go. The software generates it automatically, gives us a magenta dot. As it states over here to the left, the magenta dot qualifies and verifies the signal. Okay, entry can be considered when the price pivot is confirmed on the signal. Stop loss goes above the pivot bar high. Pretty straightforward. You want to be catching, guys, the first pullback. That's the primary trade setup that we're going to be looking for at all times, is developing weakness in the terms of a premium, looking for that first pullback, all right? And then subsequent trades can be considered, all right, as prices continue to move in a trending condition, all right, but each trade will need to be evaluated, you know, at the appropriate time, but the same conditions there will apply, right? Price a little retracement bounce. I prefer to have price in the red zone somewhere, okay, but there will be conditions where a premium will occur outside the red zone, all right, and that's what we call a turbo, and that is accelerating momentum. So that is still a trade on the second one down below that you can consider. Again, there's your magenta dot, entry there, stop goes above the high, and then begin to manage the trade. Okay? Study these graphics in future reviews of this workshop. You will get to see these and know these like the back of your hand, and they're very powerful. So now what we're going to do here, we're coming into the conclusion here. We're going to give you some trade guidelines. All right, sort of kind of like a checklist, but more of a guideline. I don't necessarily like to create an actual checklist 1, 2, 3, 4, but rather give you some guidelines. All right. And then you work with these guidelines as you're reviewing the chart. So, long discount trade setups. Since by definition discount is weakness, we want to buy weakness in developing larger degree strength. Very important. You want to make this, maybe you want to print these out. We want to buy weakness in developing larger degree strength. That is the type of discount that we want to enter on. The short premium sell trade setups, since by definition premium is strength, We want to sell strength, but again, in developing larger degree weakness. We want to avoid buying discount in larger degree weakening conditions. Okay, let's go back to the previous slide for a moment. Over here to the top left, what do we have? We have discount. The alert bar is showing us. By the way, the arrows, since they're pointing up on a discount and pointing down on a premium, do not necessarily mean, that you have to buy that bar. What the arrows simply are is pointing to the bar. All right? An up arrow doesn't necessarily mean up, or a down arrow means down. It's just pointing to the bar, just so you're clear on that. But here's the discount. Discount in weakening conditions. We want to avoid buying discount in weakening conditions. So if we're avoiding buying discount in weakening conditions, can we sell a discount in weakening conditions? That's going to be the subject of our next workshop that we'll do as it relates to premium and discounts. We want to be able to identify that discount. Is it in strengthening conditions or weakening conditions? That's the primary identification. And then once we have that, how, do we take it? Do we avoid it? What do we do? And based upon your observation of what is happening, will determine your course of action. Okay? So again, on the avoidance side, we want to, in terms of buying discounts in developing weakness, we want to avoid that. We do not want to buy discounts, right, in larger degree weakness, equals no long. And then when we have selling strength in developing weakness, we do not want to sell strength or premium in developing strength. All right, so premiums plus larger degree strengthening conditions equals no sell short. These are going to be your primary guidelines to trade the CCI / premium discounts on the crossover method. Okay? And lastly, for a little bit, further technical stuff, this is basically the alert criteria that we use, and we use what's called if-then-else conditional statements in our computer programming. So some of you like a little bit more technicals. Here's for the potential of premium trade triggers. So simply, if the CCI fast crosses over the low line, which is the -100, then the alert CCI buy signal. Okay? For the sell signal, if the CCI fast crosses underneath the high line, which is the +100, then alert CCI sell signal. So you can go through, this could be just a simple definition for you, alert criteria. This is the alert criteria that I use. Very straightforward, very robust. All right, very accurate. Okay, everybody, that will conclude this edition, Module 19 on the CCI crossover method. And let me know if you guys have any questions. Otherwise, we'll conclude here. We're just upon an hour now. And that's it. So let me know if you have any more questions. Otherwise, we'll let everybody go. All right. You'll be able to review this video 24/7 on the website. All right. So have a great Thanksgiving, everybody. And I appreciate you taking the time here today to view this with us. Hope this has helped, and we'll see you in the trading room and at the next module. Thanks, everybody.